Assalamu alaikum, welcome back, listeners. I'm here to discuss chapter number 13 of financial accounting, which is about corporations, organization, and the capital stock transactions. In my previous lectures, I have discussed with you partnership accounts, its formation, its income distribution, and its liquidation. And now, from chapter number 13 to onward, we will be discussing about the companies or the corporations, which is next step after the partnership, or you can say a bigger setup of organization or business, which is more expanded or which have more functions as compared to the partnership. In this chapter, I'm going to discuss four learning objectives with you. This is part one of the lecture for chapter number 13. And in this, we are going to discuss first two learning objectives. Learning objective number 3 and 4 will be discussed in the part 2 of this chapter. So the first learning objective which we will be discussing, that is about the major characteristics of corporations. The second one is going to how we are going to account for the issuance of the common and the preferred stock. What are they? We'll be discussing in a while. Learning objective number 3 is about the treasury stock, while learning objective number 4 is another part of the statements, which is for companies only or corporations only, not for the partnership, or you can say sole proprietorship. Okay, starting with the basic characteristics of the corporations. So this is learning objective number 1. Firstly, we should make it very clear that the corporations are separate legal entity. They are also known as artificial persons. They are different or distinct from their owners. So they are treated as a separate entity. Their interest is not merged with the owner's interest, like which is in partnership and in the sole proprietorship. It's not true in case of companies. In case of companies, the business setup is different than the owners. Companies are classified, or you can say the companies are formed based on two different classification. If we talk about classification based on the purpose, then in that case, some corporations are not for profit and some are for profit. If I say not for profit, there are many examples for not for profit organizations whose business is not to earn the profit but to serve the community. So usually the society, hospitals, or you can say some dispensaries are is particularly relevant to US. We have Salvation Army and American Cancer Society. So these are known as not for profit organizations. If we talk about profit, so most of the business which are currently in active, or you can say which are active, their basic purpose is to earn the profit. So most common examples here, you can see McD, Nike, PepsiCo, and Google, and many more. They all are having the business, or they all are the type of corporations which are made or which are formed to earn the profit. So their purpose is profit. The second way of classification for the corporation is how do you classify them based on the ownership. When I say ownership, so I have two categories based on ownership. Number one is publicly held, and the second one is privately held. Publicly held are those corporations whose owners are general public. They all have purchased, the part of the ownership, and they are known as owners. Or in common sense, or you can say in common wording, we use the word of shareholders for them. Whereas privately held organizations, their owners are some private investors. They are not open for the general public to be, owned. And we also call them closely held corporations. Another name for privately held corporations is closely held corporation. Examples for the publicly held corporation are McD, Nike, PepsiCo, and Google, whereas private held corporation are Cargill and Corporation, and many more. So here we have discussed about two different classifications, or you can say two different categories of organizations. Moving towards the characteristics of corporations, so I'm also dividing these characteristics among the advantages and disadvantages. The following characteristics are different for the corporations as compared to the partnership and sole proprietorship. They are different in partnership and sole proprietorship. If you see here, the first one, separate legal entity, limited liability of the stockholder, transferable ownership rights, ability to acquire the capital, continuous life, and corporate management. They are characteristics as well as advantages of the corporation. Whereas government regulations and additional taxes are, corporate management is sometimes advantage and sometimes disadvantage, whereas government regulation and additional taxes are classified as disadvantage. So let's see them one by one, and mainly why the corporate management is considered sometime as advantage and sometime as disadvantage. Starting with the separate legal entity, as I already mentioned, that it is this the corporations are separate or distinct as compared to their owners. So when we call them artificial person, it means that they have their own name. They are not run on the name of the shareholders or the owners of the company. Owners of the corporations are known as stockholders as well as shareholders. Second characteristics or second advantage you can say, that is the limited liability of the stockholders. We have discussed about sole proprietorship and partnership that their owner's liability is unlimited. But in case of corporation, the liability of the owners is limited. Up to how much extent? The amount they have invested in the business, up to that much extent their liability is limited. If business still needs more money, the personal property of the owners is safe in case of corporations. Third characteristic or the advantage is known as transferable ownership rights. In case of proprietorship, because it's one person, it's not possible for him to transfer his ownership. So either he will close the business or he will completely sell the business to someone else. In case of partnership, whenever a partner wants to withdraw from the business or he wants to leave the business, the partnership contract comes to an end and the new contract is formulated. Whereas in case of companies, the owners can easily transfer their ownership to another person without disturbing the business setup or business contract. So, if let's suppose Mr. A is the shareholder of company and he does not want to remain the owner or the shareholder of the company in the open market, if it is a public company, he can easily sell his shares. Shares are also known as stock, just like shareholder holds the share of ownership. Stockholder means you own a stock or a share in the business. So both things are same. So you can easily sell your ownership by selling your shares to another person in the market. Fourth advantage, or you can say the characteristic is ability to acquire the capital. It's very easy for corporation to get the capital if they need more finance or if they need more money. How can they do that? They can issue more shares and more owners can purchase the shares and more people will become the owners of the company, and as a return, corporation will get the money. Another characteristics and the advantage is known as continuous life. As I already mentioned, that in case of sole proprietorship and partnership, if a person leaves the company or he withdraws from the company or a person dies who is an owner, the contract is supposed to be made again, and in case of sole proprietorship, the business will be closed. But in case of companies, the things are not affected, so the businesses are considered as continuous or the going concern, means they will keep on running the business. They are not affected if an owner withdraw money from the business or he dies, or the stockholders does not have finance to support the business, or any employee leaves the business or an officer leaves the business. The corporations are not affected, they keep on working. Moving on towards another characteristics which is known as corporate management. Now, corporate management is if you talk about in positive direction, it's an advantage, but it's mostly considered as disadvantage as well. So I'll discuss the positive side of corporate management, and then I'll move towards the negative side, which is disadvantage for the corporate management. Corporate management is an advantage, means the owners, they don't run the business. We have a separate team of managers, or you can say separate management, who are responsible to manage the company. They are expert in their area, and they run the business efficiently. The separation of ownership and management, um, its advantage because of the expertise of the managers, but it becomes a disadvantage in other way. How come it's a disadvantage? When the owners do not participate often in the business, then they don't have control on the business, or they don't know what is happening in the business. So their ownership ability to actively manage the business is reduced. There is a very big issue which is relevant to the corporate management, that is known as information asymmetry. Information asymmetry means that the information which managers are having, it's different than what owners are having, because managers are the one who are actively running the business. So if managers, they do not practice, if they don't have good practices, or they tamper or they exaggerate the business accounts. Why? Because mostly they are compensated based on their performance. So if they just give a good picture to the finance of the company, though the company is in crisis or it's not doing that well, then in that case ultimate effect comes on owners. So in this way, corporate management is considered as a disadvantage. Another disadvantage is government regulation. Companies, especially the public companies, they are watched by many government organizations, like stock exchange requirements they have to fulfill. They have to follow the state law. They are supposed to be meeting the requirements of Securities and Exchange Commission, which is SEC, and also some federal regulations. So they are highly regulated, which increase the work of reporting. A lot of reporting work is supposed to be done in order to meet the legal requirements. And finally, the additional taxes. Sole proprietorship and partnership, they are taxed only once, because the businesses are not considered separate than their owners. Whereas in case of corporation, it is dual tax. When I say dual tax, it means that firstly, corporation, they pay the income tax on their on their income, and then the income is distributed as dividend to the owners, and then owners pay the tax on the cash dividend. So it's actually the same income which is double taxed. So this is another disadvantage of the corporation. Let's see how the structure of the management hierarchy looks like in case of corporation. So owners, stockholders, shareholders, they are at the top of the hierarchy. Then, because they don't manage the business actively, so some of their representative are the member of board of directors, or you can say a team of the stockholders along with others. They are the members of board of directors, and from those board of directors, one person is serving as chairman. Then under the board of directors, they have president or CEO, chief executive officer of the company. President and chief executive officers, they monitor different departments, presidents or vice presidents, like general counsel secretary, or general counsel, or you can say marketing vice president, finance vice president, operations, human resource. As many departments the corporation have, their presidents or vice presidents are going to report this CEO and the president of the company. Some companies, they have presidents, some companies, they have CEOs, and then CEO is going to report the board of directors, and board of directors are going to report the shareholders. Where do we fall, accounting and finance people? So here is our place: vice president of finance. Under that, the treasurer and the controller works. So this is the area for accounting and finance. So if a corporation is going to be formed, what are the steps? What are the requirements? So initial steps are, firstly, they have to file the application with the Secretary of the State, that company, originators or initiators, they will file an application that we want to form a company. This application will be reviewed by the government authority, and then if they agrees, they will grant the charter. What is a charter? Charter is also known as article of incorporation. It's a permission that you're legally allowed to run the business. Um, Companies, whenever they want to start the business, they always check the market requirements, that are they really needed in that state or in that province or in that area, or do they have customers in that area, and then they start their business. So companies generally incorporate in a state whose laws are favorable to corporate form of business. Some examples of Delaware and New Jersey are the examples. You can take the examples from KSA. Uh, some companies, they work in different states or different provinces, as well as in other countries. So wherever they want to operate, they have to take the legal license, or they have to take the charter to operate in those states. Moving on towards the, you can say, the stockholders or shareholders, what are their rights? So if you talk about the rights of the stockholders, firstly, they have a right to vote. Though they don't participate in the management, but for the mega decisions, they are the one who vote. Especially when the time for the election of board of directors is there, because board of directors are their representatives. At that time, shareholders will vote that who to whom they want to be the member of board of directors. And also, there are some, decisions in which the shareholders' approval is required. Then another right for the shareholders or the stockholders is that they share the earnings of the business. So when the company has net income, company gives dividend or the distribution of earnings to the shareholders. Distributing earnings to the shareholders is known as dividend. Another right of the shareholders is that in often, I will not say always because it's not always the case, but yes, often, most of the time, they keep the same percentage ownership when the new shares of the stocks are issued. When I was discussing the characteristics of corporations with you at that time, I mentioned that the corporations can raise the finance or capital whenever they want. So they can issue the new shares, right? So when they issue the new shares, new people will acquire the share. So where Mr. A was having 30% shares of the business, by issuing new shares, number of shares will increase, might be his percentage will decrease from 30% to 25%. So in order to save him, some companies, they provide preemptive rights option. Preemptive rights means that before issuing the shares to new owners, the old owners are given a chance that they can purchase the shares. And if they purchase, they can maintain the same percentage of their ownership, but it's not compulsory. It's completely at the discretion of the owner. He wants to purchase new shares or not. And also, all the companies do not go for the preemptive rights, but few, yes. So that's why a number of companies, they have eliminated the preemptive rights. So what is preemptive rights? Giving a chance to the old owners that they can purchase the new shares of the company when company is raising finance. Another right of the shareholders is residual claim. What is residual claim? Residual claim means that if the business is going to be closed or it's going to be liquidated, after settling all the liabilities, after paying to all the creditors, the rest money is distributed to the shareholders. Now, let's talk about some of the consideration while issuing the stocks. So, when the companies are going to issue the stock, they should be clear about few questions, or they should have a clear idea about certain things. So, what are they? Number one, how many shares they are authorized for sale. Authorized means maximum what is their capacity given by the state, that how many shares they can issue throughout their life. So that is known as authorization or authorized capital. Companies never issue 100% of authorized capital, they only use some part of it. Second, how should they issue the stock? Third, what value should the corporation assign to the stock? Means how much they should charge for one share, one stock. So these are the things which companies should consider before issuing the new shares. Moving on towards the different, you can say, categories of shares which we mention in shareholders equity, that is authorized capital number one. So I just discussed that authorized limit of the stock. So authorized capital or authorized stock, they are the same thing. This is the maximum limit given by state to this company. So we can say this is mentioned in the charter. Charter is the permission, right? So or article of incorporation. So charter tells that what is the amount of the stock that company is authorized to sell throughout its life. Um, we mentioned when we prepared the stockholders equity, which is one of the report we prepared for companies, in that we clearly mentioned what is the authorized capital. But this is because maximum limit allowed, there is no transaction which happened, this is just a ceiling. So that's why there is no journal entry to record the authorized capital. This is how the share looks like. It's a document. When the companies are going to issue the shares, so companies, they issue the shares directly to the investors. How can they issue the shares directly to the investors? They can make a public announcement that we're going to launch our these many number of shares. If you're interested, you can pay this much price for each share. Or they can issue the shares indirectly. What is indirectly? They can take the help of investment banking firm. What is investment banking firm? Investment banking firm is an organization which helps the company in selling its shares to the general public. When you choose which price to offer, or you can say at what price public can purchase the shares, that price is set by considering the following five factors. Number one, what does company expect about its future earning, or you can say what is company's expected or anticipated future earnings. If company expects that our earnings will be high in the future, they can charge a high price for the new shares, because people will love to purchase these shares at high prices because they know company is expecting high earnings in the future, so they will be willing to pay more. Also, the expected dividend rate per share. Again, in future, what is company's policy to issue the dividend on shares? If higher dividends are expected in the future, then in that case, company can set higher prices for the new shares. What is the current financial position of the company? If company's financial position is strong, company can issue the shares at the higher rates, and people would love to buy. Uh, what about the current economic situation, or you can say the current state of economy? Is it at boom? Is it at recession? So, if the economy is prospering, it's a good picture of the economy, then in that case, companies issues the shares at higher prices. And the last one is current state of the securities market. In securities market, what is that trend right now? More buying and selling is happening, and what's the situation, or what other companies are doing in the stock market, that also defines what prices you should put for your shares. Okay, when we talk about the issue price, at the same time, we need to take a concept of the market price of the stock. Market price of the stock means what price of shares exists in the market. So when I discuss the companies by ownership, or categorized by ownership, at that time I discuss private or public companies and the privately held corporation. So public companies, their shares are traded in the market. So which market? That is organized stock exchange, or the organized exchanges where the company shares are traded. Some people are selling, others are buying. So the trade is happening in the organized exchanges. Um, So market price is a price which is settled by an interaction between the buyers and sellers, those who wants to sell the shares of the company and those who wants to buy the shares of the company. Their negotiation, their interaction defines the market price, at what price they agree to buy and sell the shares. um, these agreed on prices are truly based on what is the situation of the company about its future earnings and dividends. If the future earnings and dividends positions is good, then in that case buyers will be willing to pay higher prices which sellers are charging. Also, the market prices fluctuation which are beyond the control of the company, that also defines what is the market price of the shares. Another important thing relevant to the stock issuance, that is known as par and no par shares. So par means the stated face value of the shares. So when I say face value or par value, they are the same thing. In old days, most of the companies they usually define the par value for the share, and this was required. The company must retain it in the business, or you can say this is the minimum amount for the shares company should have in its owner's capital. But nowadays, most of the companies they do not have the par value or the face value concept. It's very common that companies issue no par value stocks, and in some countries, I would not say states, I would say countries, the board of directors, if there is a no par value share, there is no face value of the share, they assign it a stated value. Stated value is similar to the par value, but it keeps on changing and it's very minimal amount. Now let's see how the structure of owner's equity looks like in case of corporation. So in case of corporation, owner's equity has two primary sources. One is paid-in capital and the second one is retained earnings. What is paid-in capital? Paid-in capital is the total amount of cash or other assets paid into the corporation by stockholders in exchange for the capital stock. So paid-in capital includes full amount which it has collected from the shareholders, or you can say it has collected from it could be an amount, it could be any asset, but in exchange to the shares. So for example, some shareholders they pay the cash to get the shares of the company. Some shareholders they give the assets like building or something like that to purchase the shares of the company. So whatever considerations, either it is cash or other assets, the combined amount is mentioned in paid in capital. Whereas retained earnings, as its name says, retained, they are kept in the business, they are not distributed as dividend. So when the companies have net income, some part of the net income is distributed to the owners as dividend, but some part is retained in the business for future uses. So the part of the profit which is not given to the owners as dividend, that is known as retained earnings. Let's take one example that how the company owner's equity looks like. So if Delta Robotics has a balance of $800,000 in common stock and $130,000 in retained earnings at the end of its first year, how would its stockholder equity look like? You know, balance sheet has assets. They will be exactly the same like sole proprietorship and partnership. Then it has liability, the same in sole proprietorship and partnership. But in case of companies, we will have stockholders' equity. Firstly, the paid-in capital will be mentioned, and then the retained earnings will be mentioned, make a total, and that is the total stockholders' equity. Let's quickly see in paid-in capital, we have two categories. Either companies issue the common stock, which is issued to the general public, or they issue the preferred stock. Preferred stock are issued to some special people. They are not allowed to publicly trade the shares. I'll be discussing their features in a while. And another account is known as paid in capital in excess of par. So this account shows us that if the shares are issued higher than the par value, then what extra you charge, that comes in paid in capital in excess of par. I'll give you a common example over here. Let's suppose the par value for the common stock is 5. Okay, but it was issued um, for $15 because I told you issue price is defined based on some factors. So $5, let's suppose company issue only one share. So $5 out of 15 will be mentioned in common stock. Rest extra, which is 10 above the par value, that 10 will be mentioned in paid in capital excess of par. Paid in capital in excess of par could be for common stock, it could be for preferred stock. Let's move towards how does the capital account look like in all the three types of corporate companies or businesses. So when we talk about sole proprietorship, it has owner's capital only in its capital account, and it has a normal balance of credit. In case of partnership, as many partners are there, that many capital accounts would be there. In case of companies, we do not have owners account separately. We have one common stock, or you can say one paid in capital account and one retained earning account. This is do it. So I hope that you people will do it. It's about presentation of owners equity. Let's move towards our second learning objective, that is how do we account for or how do we record the issuance of the common and the preferred stock. What is common and preferred stock? The two types of stocks which company issue, common and the preferred stock. So let's have a look at their accounting. Accounting for the common stock, firstly we will be covering primary objective. What is the main objective? Identify the specific source of the paid-in capital. It's one of the source for the paid-in capital, and it maintains the distinction between the paid-in capital and retained earnings. Okay. Other than the consideration received, the issuance of the common stock affects only paid-in capital account. So whatever considerations you are receiving cash or you are receiving other assets, the effects will be in paid-in capital account. And we know that paid-in capital account has two categories. If common stock is issued, with common stock we might have paid in capital in excess of par common stock. If preferred stock is issued, we might have paid in capital in excess of par preferred stock account. Let's have one example. Issuing par value common stock for cash. Now I told you three different considerations. We might have a par value stock. We might have a non-par value stock, means we don't have a face value for the share or stock, and company management has assigned it a stated value. And the third case is company has no par value stock and there is no stated value for it. Okay, so let's start that we are issuing the common stock which has par value. Let's start with the first case. Assume that Hydros Lights Incorporation issues 1,000 shares of $1 par value common stock. Now you can see we have par value in this example, that is $1. And how many shares are issued? 1,000 shares are issued. Now the requirement is prepare the Hydros Lights journal entry. If now part A is 1,000 shares are issued for $1 per share. So issue price is also set as $1. Par value is $1. Issue price is also $1. So company gets the cash. How much cash? 1,000 shares are issued. 1 is the issue price, so that is 1,000. And common stock gets credit. Moving on towards the part B of the question, 1,000 shares are issued for $5 per share. What is the par value? $1. Common stock is always mentioned with par value. Okay, so whatever is the issue price, common stock will always be calculated based on the par value. So now for the part B, company received the cash. How much cash company collected? 1,000 shares company sold and they have collected $5 for each. So 1,000 multiplied by 5 is 5,000 is the cash company has collected. For what? Because they issue the common stock. So common stock gets credit. 1,000 shares are issued. I mentioned that common stock is always recorded with the par value. Par value is 1. So 1000 multiplied by 1 is 1000. And the remaining will go where? Remaining will go paid in capital in excess of par common stock. Remaining is how much? Issue price is 5. Out of 5, 1 is mentioned over here. Remaining is 4. Okay. For how many shares? 1000 shares. So paid in capital in excess of par common stock, that is $4,000. So now the journal entry is balanced. Let's see how the balance sheet equity section will look like. So shareholders equity, paid in capital, common stock is here. This is a presentation. Common stock is here, 2000, and the paid in capital in excess of par, that's 4000. Total paid in capital. So focus on the presentation, don't bother the amounts. They will keep on changing based on the scenario. So under the stockholder equity, firstly we mentioned the first head, paid in capital. Under the paid in capital, we mentioned the common stock. Common stock is reported at par value and then paid in capital in excess of par common stock. By adding these two, we get total paid in capital. And after that, we mentioned the second part of the stockholders equity, that is retained earnings. These are hypothetical figures. They are not, the real figure relevant to the previous example. Let's move towards the second case, which is we are issuing the shares, no par value, but yes, we have a stated value. Okay, assume that instead of $1 par value stock, Hydroslide Incorporation have $5 stated value, no par common stock. So the common stock does not have a par value, but management has assigned it $5 stated value. Stated value is treated exactly like par value. Okay, company is issues 5,000 shares at a price of $8 each. Okay, so company gets the cash by issuing 5,000 shares. Each share charges a price of $8. So how much cash company gets? 40,000. Common stock is always, as I mentioned before, common stock is always reported at par value. In this question, we do not have par value, we have stated value. Stated value is also treated like par value, so 5. Okay, it's given over here 5. So 5 multiplied by how many shares? 5,000 shares. So common stock gets credit with 25,000. So out of 8, 5 is mentioned in the common stock. Remaining is how much? 3. How many shares? 5,000 shares. So 3 multiplied by 5,000, we get paid in capital in excess of stated value. Common stock, 15,000. In this way, our journal entry is complete. Next, third scenario. We do not have any par value, neither we have stated value. Then there will be no chance to have paid in capital in excess of par. So same case, I'm treating this the same question, but there is no par and no stated value. Okay, this is the stated value. So in the next part, I'm not considering any stated value. So then what will happen? Whatever cash I receive, common stock will be recorded with the same amount. So cash is 40,000. How come? It is per share. 5,000 shares are issued. So 40,000 cash and the full amount is credited to common stock. This example was for the cash purchase of common stock. What if company sells the shares for non-cash basis? So issuing common stock for services or non-cash assets. Someone has given the services to the business and instead of paying them money, company has issued the shares to them. Or someone has given the assets to the company and instead of giving them money, company issues the shares. So these are the two cases where company issues the shares not for cash. It issues the shares for services like attorney services or consultancy services. Somebody has given these services to the company and company is paying them shares. Or someone gives them a company assets. I mean, somebody is giving his land or building to the company and company is issuing them shares. So cost, now how to record the journal entry, because we do not receive any money. So what shall I debit? So they say either cost is either how I'm going to record. It is either the fair market value of the consideration given up What is consideration given up? Company is giving shares. That's the fair market value of the shares. Or the fair market value of the consideration received. What company is receiving? The services or the land and building, its fair value. Whichever is more clearly determinable, whichever is very clear to you, whichever is more reliable. Consider that for the recording purpose. I have few examples for you which will make this concept clear. Attorney has helped Jordan Company incorporate. They have billed the company $5,000 for their services. So attorney has given the services to the company for $5,000. They agree to accept 4,000 shares of $1 par value common stock in payment of their bill. So company did not pay them cash. Company issues its shares. So now I cannot debit cash because I did not receive the cash, but yes, I have organizational expenses. Attorney has given me services, right? So they are my organizational expenses. What was the amount? 5,000. Now I have issued the common stock. How many shares? 4,000. Common stock is always recorded at par or stated value if they are. Okay, so we have par value $1. So 4,000 multiplied by 1, that is 4,000. Remaining will go to paid in capital in excess of par common stock. So remaining is how much? Remaining is 1,000, right? Full amount is 5,000. 4,000 I recorded here. Remaining is 1,000. Let's take another example. Okay, in this example, if you see, I do not have fair value of consideration given up. We give shares, right? Our consideration given up is fair value of shares. We don't have in this question. But yes, consideration received is $5,000. A bill is a clear evidence. That's why I record the journal entry based on the bill amount. The second example is for the fair value of shares. Atlantic Research Incorporation is an existing publicly held corporation. It has $5 par value stock. Its $5 par value stock is actively traded at $8 per share. So yes, I got the fair market value, right? Because at this price, it is traded in the market. The company issues 10,000 shares of stock to acquire the land. So they want to buy a land and they issue 10,000 shares for that land. They did not give the cash, they issue the shares. The land is recently advertised for sale at $90,000. So the advertisement amount for the land is $90,000. They want us to prepare the journal entry. Now what shall I take? Shall I take the fair value of the share, $8, or shall I take the advertised value of the land? They say whichever is more clearly determinable, right? If you see here, the fair value, or you can say the traded value of the share is more authentic in this example. Why? Because land is advertised price is $90,000. People negotiate even after that advertisement. This company might negotiate with the seller, and maybe the seller would agree at 85 or 80 or 88,000, right? So as compared to 90,000, this market of the share fair value is more acceptable. So that's why I will be recording the land not with 90,000. I'll be recording the land based on $8. Okay, this is $8. So $8 for each share. How many shares we have issued? 10,000. So land will be recorded with 10,000 multiplied by 8, that is 80,000. Common stock is always recorded at par. So par value is $5. How many shares are issued? 10,000. So 10,000 multiplied by 5, that is 50,000. Remaining goes to paid in capital in excess of par common stock. So since we are discussing a common stock, let's discuss quickly about the preferred stock as well. So preferred stock are issued to some priority owners, those people who have done something special for the company. So they are typically preferred shareholders, and they have why they are preferred? Because they have priority for what? For the distribution of earnings. Means whenever company will start giving the dividend as the distribution of the earning, always the preferred stock will be paid first. Whatever will be left over, that will be given to the common stockholders. Also, if company closes its business, it's liquidate, firstly, the claim of the preferred stockholders will be paid off after creditors, and then the remaining money will be given to the shareholders. So that's why, because they don't compromise on the dividend and at the claims at the time of liquidation, so they are not allowed, to vote, because in case of companies, the owners participation is only up to the voting, right? So preferred stocks are not allowed to vote because they don't compromise on dividends or the claim on the assets at the time of liquidation. The entries are exactly the same as we do for the common stocks. The only difference is, instead of crediting common stock, we credit preferred stock. Let's see this example. Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. So 10,000 are issued, par value is $10, and the issue price is $12. So let's record the journal entry. What do? We receive cash of $12 for 10,000 shares. So how much cash I collected? 12 multiplied by 10,000, 120,000 cash I have received. Preferred stock, just like common stock, preferred stock are recorded at their par value. So 10,000 shares, par value is $10, that is 100,000. So the excess is how much? 12 was the issue price, 10 is the par value, so remaining is 2, right? So 2 multiplied by how many shares? 10,000 shares. So that's come up 20,000. Preferred stock could be a par value or no par value. So same treatment like the common stock will be done for the preferred stock. So, listeners, this is the end for the discussion of part 1 of chapter number 13. I'll come back with chapter number 13, part 2 in after some time. Please like and subscribe so that you can receive the notification for my new videos when I will be uploading them. Take care, everyone. Bye.